How is
How is
everybody
everybody
doing? This is
doing? This
Bob
is Bob
Chino from the
Icino
Pure
from the Pure
Exposure Growth
Exposure Growth
Series.
Series.
Welcome to
Welcome to
another live
another
stream.
live
Looks
stream.
like we
Looks
got
like
this
we got this
working.
working.
Pretty excited
Pretty
about
excited
this.
about this.
I
I
am
am
going
going
to
to
be bringing in Jimmy Iurio in a minute. As soon as I can link this up, and we'll get started here. Give me 1 second, letting a few more people log in. There we go. I think we got enough people coming in. Jimmy, can you hear me?
I can hear you fine.
How are you, buddy? It's good to talk to you again.
Good to talk to you too.
So we are, of course, live again here, and we're looking at kind of the same market as the last time I talked to you, really. I mean, we're looking at a market that is NASDAQ driven, that is higher. You mentioned in the last show that you were mildly bullish, but you were cautious. You were right. Things kept going up. And before I ask you a couple of questions, I just want to remind everybody who Jimmy is. Jimmy is the A Managing Director at TJM Institutional Services, and he is a CNBC contributor, as well as Jimmy. How long have you been doing this now?
33 years. How about that?
Wow, man, 33
Yeah.
years of doing this stuff. Well,
Yeah.
I'm pretty happy to have you on.
Yeah.
I'm pretty happy to have you on here. So let me ask you a question, if I could, from a perspective of the markets themselves. Do you think these markets are functioning correctly? Do you think this is the kind of market that's sustainable from a standpoint of maybe the NASDAQ pulling everything else up? I mean, we had some news today that DocuSign is replacing United Airlines in the NASDAQ 100. That's Adobe's in there. I think Spotify's in there as well now. So from a standpoint of what's been going on in the markets, technology versus everything else, do you think this is sustainable?
Well, this is a fascinating question. When you tell me that DocuSign is replacing United, this like underscores a lot of the craziness that we've seen over the last few months. And it's sending a message that we're not necessarily getting back to normal. Obviously, if United Airlines is becoming an unimportant stock, I don't agree with that. But what I'm trying to say is that this is a very reactionary sort of environment we're in, and this is another example of that. As far as tech leading the way, this has been fascinating to me because right from the March 23rd low, that was the day where they said QE to infinity, tech started outperforming mightily. And the theory behind it is that all the stay-at-home names are going to be the ones, the technology, and you keep people not going into the office, and connectivity was a huge part of it. But then when it seemed like it was time to rotate back, the market seemed to be like, okay, so who has the best balance sheets? Who seems to be the safe bet? Again, technology, particularly those top 6 or 7 companies that we talk about, companies like DocuSign and Spotify. Here's what I see is that I see the major great balance sheet tech names dragging up the NASDAQ. And there's an actual mathematical correlation. Like if people start buying the NASDAQ, start buying the QQQ ETF, those names get pulled up as well too. So you ask, is it going to continue? It seems like it's going to me.
All right. So from a perspective of just general markets, you think it's going to continue to the upside. Is this a situation where you and I have both been around long enough to see how long Japan just basically QE'd their markets to death, and it didn't really, it didn't work. So what is the difference then in terms of like, are we Japan, and why would ours continue to work where theirs isn't? And maybe I'm putting words in your mouth. Maybe you don't think it's going to continue to work.
Well, no, I think work for economics and work for asset prices are two wildly different things, and we both agree on that. To work for the economy and make these stocks get back to a situation where we can say it's real pricing, it's pricing in much more organic ways than it is now just with Fed intervention, that would presuppose that they have to pull back in a timely fashion. I do not have great confidence that they'll do that. The Fed has not ever really shown a willingness to pull back. They seem to be very, very worried about asset prices. But the whole thing, when I look at the current situation right now, I see the unknown is obvious. There's statistics that are coming out about the virus, that some of which seem scary to people in markets, some of which seems very encouraging to people in markets. And I'm sure you know what I'm referring to. But those are the things we don't know. What we do know is this, is that the Fed, Larry Kudlow was just on air a couple of minutes ago talking about a potential another package, bailout package, injecting money into the system. The Fed has been extremely dovish. I don't think they have much of a choice of being to be extremely dovish. I think they have to. So right now, if you believe there's even a possibility that things are getting much better and virus related and the economy is starting to come back online, and we know that all those factors that are causing the buoyancy in the market, Fed, government, and not just our Fed, the world's central banks, a lot of that money leaks into the U.S. stock market as being the world's tallest midget kind of thing. So that's why I still remain.
I'm chuckling at the world's tallest midget kind of thing there for a second, because we had a little thing. Jimmy and I have been on CNBC together, and we were basically the same height, and he was kind enough to look at me and say, I really thought I was taller than you, which is kind of funny on top of it all. But let me ask you, buddy, from a perspective of you want to, so you want to be long this, but you still want to do it via options the way you always do. So if you could kind of give people a look at the trade you're looking at and tell us, because you usually do trade examples, not necessarily actuals. So what, from a perspective of, do you have this trade on? Are you looking to put this trade on? And tell people about the specific trade if you don't mind.
To the extent I want to have it on. But I also have these same strikes on for today's expiries, and the one I'm going to be talking about now is Wednesday, so 2 days from now, June 24th. And I like buying a call calendar. That's the Wednesday, June 24th again. The 3100, I said a call calendar, I meant a call condor, I apologize. Buying the 3100, 3140, 3150, 3185 call condor. Now, this is different than the call flies that we sometimes talk about, is that I like to think of it this way. I'm buying a 40 wide call spread, the 3100, 3140 call spread, and then selling the 3150, 3185 call spread. So I'm buying a 40 tick wide and I'm selling a 35 tick wide. And I'll tell you about why I'm doing that in a second. Remember, if this was a call fly, those middle strikes would be the same. So in a call fly, you kind of, to make the maximum out of, which nobody makes the maximum out of a call fly or a call condor, really, right. You'd have to pinpoint to that exact spot. So the call condor, you pay a little bit more for, but you have that 5 tick range that it could settle anywhere in there, and you'd make the entire 40 ticks. I paid 9 ticks for that today, maybe 9 1/4. So if you paid 9, kind of trades in these environments too, because you know exactly what your risk is. My risk is the 9 1/4 ticks that I paid. And the reason I have 40 by 35, because I hate when you have on an equal distant condor fly and the market flies in the direction that you picked and leaves you with nothing, because it goes beyond your strikes and you make the full amount on the first call spread and lose the full amount on the second. In this particular one, at least you'll be left with the consolation prize of 5 ticks, the difference between the two spreads.
So from a standpoint of this versus a call fly, okay, you kind of went into it a little bit, but first of all, is this limited risk like a call fly is, or no?
Yeah. Right. You can't lose more than the 9 1/4 ticks you put out for this. So the same thing as a call fly in that respect.
It's the SEP underlying, right? SEP futures underlying. So why do you want to do this instead of, say, doing micro futures or something to that effect?
The risk reward I like, and I do like, having an absolute set maximum that I can lose. Deep down, if you know me for a long time too, and I love to trade, but I am more of a risk mitigator than a risk taker. So I like structures where I can look at them and say, the most I can lose is that 450 bucks I put up. And now this takes a lot of managing too. You know, the options where when you have a call fly or a call condor on, you have to manage it pretty actively the last day, which some people don't like that. They want it to be kind of, automatic transmission. I like the manual part of it because I'm sitting in front of the computer all day anyway. It's my gig. So I like to manage it and try to get the most out of it as I can. To put something in perspective too, like when I put this on, this had a 7 or 8 delta. The one that expires today of the exact same strikes and the exact same underlying has a 25 delta. So as this is 2 days away. As it gets 2 days, the delta is going to go up considerably.
Gotcha. All right. So that is just so everybody knows, that's a SEP underlying buying the Wednesday, June 24th expiration, 31, 3140, 3150, 3185 call condor, 9 ticks. Trade risk is about $450 to make about 1,800.
That's correct.
Jimmy, thank you again for being here. I really appreciate that, man. I appreciate taking your time. I know you're a busy guy with your institutional business, but if you want to check out that trade or talk to Jimmy about that trade, Jimmy, you're active on Twitter. Give me your Twitter handle real quick.
At Jim Iurio. That's JIMIUORIO.
Jimmy, thank you very much. I'm going to let you go, and in a few seconds, I'll bring Phil Streible
24/7 access to diverse global
and you'll
markets.
talk to him next.
Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played. Futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that.
Joe, so it's still being written right now. It should come out here shortly. And I think the latest you should.
Guys, just so you know, this particular show is sponsored by the CME Group and E-Trade. Very kind of them to do this. We usually do this from a studio, but obviously with the virus and everything, we're kind of stuck in a situation where we have to do these from home. Couldn't get in the studio. So I'm going to go ahead and bring Phil in. Phil, you good? You with us? You can hear me now, right? Phil, do I got you?
Yeah, I got you.
Go. How you doing, buddy?
I'm all right.
All right, good. So let me start out by saying that you are, I don't want to say you're known as a metals guy, but you are the chief market strategist of Blue Line Futures, and you're pretty much known as a metals and energy specialist. We talked about this before. You've been around since about 2002, and we see you on basically every channel, every technical channel, or every TV channel, I should say.
Okay. Okay. You want me to give you information on? Okay, so I work as chief market strategist at Blue Line Futures. Basically, I coordinate with a team of other individuals, and we come up with collaborative trading ideas. We offer a flexible and customizable trading approach that suits, all types of traders out there, everyone from hedgers to professional guys, and we develop a lot of research and put that out. You know, we do focus, or I specifically focus on metals and energies primarily, and looking at, the performance on gold and silver for the year. Gold's up about 16% on the year, whereas, the best performing sector in the stock market, the NASDAQ, is only up 14%. So it tells you that, there is some validity behind the bullish case on the gold market.
Do you think that's going to continue? You think there's still an opportunity to get in gold, or would you prefer silver, or you think it's pretty much run its course?
So if you look at gold, really in the last 3 months, it's been in a very tight trading range. Well, not really a tight trading range. It's been in a trading range. It's about $100 wide. In order for gold to break out to the upside, we'd have to take out 1789. That's been the highest level that we've seen over the past 3 months. Silver, so the interesting thing is that 80% of the demand for gold is investment demand. 20% for gold is actual uses, like industrial uses. Silver is the exact opposite of that. 80% is industrial uses, only 20% is investment demand. To take off to the, you need to have that, that industrial side of things just pick up, and we need to see economic activity, not only in the U.S. but globally, accelerate as well.
If you don't mind, Phil, we lost you for a second during that, and I think it's really important that you give that sort of fundamental case between gold and silver again, if you don't mind.
So if you look at the correlation between gold and silver, a lot of people think that they are just both the same underlying asset, that they're both an investment vehicle. However, there's very big differential between gold and silver. Gold's investment demand makes up 80% of total demand. 20% of it is for industrial applications and uses. If you look at silver, it's the exact opposite. 20% of silver's demand is for investment demand. 80% of it's for industrial uses. So in order for silver to really explode higher and to see that gold-silver ratio absolutely collapse, you're going to need to see industrial demand pick up as well as investment demand. And for silver, it's mainly got to be industrial demand that takes off to the upside. And that's how you're going to see the ratio collapse, and silver is going to be one of the best performing commodities.
So is that really a stock market versus economy story for silver then? Is that the way you look at it?
You're going to need to see industrial production. You're going to need to see the economy take off. It's going up right now. All commodity asset classes are basically rising right now because of the fact that the Fed is aggressively devaluing the dollar index. If you look since, the Fed's balance sheet is $7.1 trillion. Since last August, they've injected $3.3 trillion into it. U.S. consumers, the consumer's really hit right now, and the consumer's really suffering. Corporations are extremely over leveraged. The Treasury Department has issued $3.1 trillion to households. Those unemployment benefits will expire in 8 weeks. The Fed is doing everything they can right now to fill in every crack that there is in the economy. So unless the economy takes off in 8 weeks, you're probably going to see silver prices stall out. You'll see gold prices continue to accelerate higher because of that dollar devaluation.
So can you talk a little bit then, as like a lot of people have talked about, with the volatility? You see the VIX in the equity markets being around, really can't get below 31. What is your opinion as to why gold? I mean, it's up a little bit over the last couple of days, but why hasn't gold acted like a flight to safety the way it has in the past?
I mean, it has been a flight to safety. It's just the problem is that the Federal Reserve is propping up every single asset class that's out there, and they're buying, corporate debt. They're basically socializing all the problems that are in the world, and this is not. Do not confuse this rally in the equity markets being some kind of bull market or V-shaped recovery. You do not have a bull market with the volatility index. at 30, and the Dow Jones having a 700-point average true range every day. It's no retail investor is going to be able to survive handling those swings just trying to trade on their own.
So how do you see it from a perspective of gold? I'm actually not. Where is gold right now? It's I've got it here. All right, so it's about 1777. Is there room to the upside? And if so, where is it? And what would be your best way of putting that trade on?
If you look at gold right now, it's at the top end of the risk range. If you were long gold in your portfolio and you've been buying it this entire time, you need to, when we get up north of like 1780 on up to that high level, 1789, you need to take off, whatever you're comfortable, take something off, take 20% of your position off. That's why I tell people about the equity markets. I think you have to take some of your equities off of the NASDAQ at all-time highs. So when we get up to that high end of the range, take 20% off of the position. Keep your core position on, keep 50% of it, but then use those declines in the market. Like, it wouldn't surprise me if gold ends up down. The Fed's going to be having some comments this week. If gold prices come back down 1725, 1700, we're going to add that position back on. It's a trading range right now, but maintain your core position in case the breakout does occur.
Is there anything else that kind of captures your idea? Do you like crude oil? Do you like any of the energy markets? Or you just like, is metals your favorite right now?
It paints an interesting story. I mean, oil prices have doubled with, this high supply, very little demand. It's very forward looking. I did read something interesting that was that on natural gas, I think there might be an opportunity there because natural gas rig count is at the lowest level since 1987. If we do see any kind of change in the weather, you could see natural gas demand pick up quite a bit. The supplies are declining while demand could turn up due to, like I said, a weather issue. It's hot, and also a large portion of natural gas's demand is industrial demand. So I like natural gas a little bit better than crude oil to the upside.
What are the sort of specs for natural gas for people don't know? What's the front month and how's that trade per tick and everything?
Dollar move is actually $10,000, so it's quite a big contract, but the range on it hasn't been all that big recently. The current contract that we're trading here at the moment, let me pick it up for you. We're in the July natural gas. It's $1.68 right now. So if it goes from $1.68 to $1.69, that's going to be $100 move. I don't recommend just going all in on any one of these commodities. You need to have a plan. You need to write out your plan, and you need to trade that plan using risk management, things like that. Natural gas, we would take more of a longer term approach. Look at September, most likely buy like a couple of the 220 calls. They're running about $600 each. If we do see that pop, we'll unload one of those calls, maintain the other. We like to maintain a core position in the market and use the smaller aspect of the position as a trading vehicle.
So back to the metals, do you guys recommend more of the micros and just people kind of scale into a position from that, or do you go with the bigs and just find the right spot?
So you should adjust, when you look at any of these markets, if gold normally has like a $10 to $12 daily range, you have to use that fluctuation, base it upon your account size, and decide if that's an appropriate trading vehicle. Now that the average range on gold is like $40, that's $4,000 move for the 100, the 100-ounce contract. We use a lot of those micros, a lot of the 50-ounce contracts to try and build positions. I think that in this low commission environment, it makes logical sense to have these smaller positions and to build them over time rather than just jumping all in, with a few 100-ounce contracts.
Phil, I really appreciate you coming on the show again. We're running a little bit behind, so I'm going to let you go. But thanks again. And where can people reach you if they'd like to talk to you?
I'm at Blue Line Futures. You can email me at phil@bluelinefutures.com or visit our website, www.bluelinefutures.com.
Thanks, buddy. I will talk to you soon. We'll come right back with Todd Kobayashi. There's a lot to talk about with Todd, so we'll be back.
24/7 access to diverse global markets. Right here That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played. I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that.
All right, we are back. I've got Todd Kobayashi, who is senior partner at Enerstrat Partners. It's a firm that provides consulting advice in the broad real estate space. Spent about 7 years as a real estate CFO. Todd is also the guy, if you ever hear me talk about my history, he is a guy that I worked for. He taught me a lot of price action stuff. I like to think I improved on everything you taught me, or improved rather. But yeah, going forward, he would be somebody that you would hear me talk about as like one of my original mentors. So let's talk to Todd. Todd, how are you, buddy? It's good to see you again. Just kind of, if you could, give us sort of just a general as to what you do now.
Thanks, Bob. Yeah, so I basically finance a number of real estate projects across the commercial real estate spectrum. That's a majority of my activity today.
All right. Well, we've got a lot to get into with you, and I know that you wanted to talk about precious metals. Now, we just talked to Phil Streible from Blue Line, who is bullish gold. I know you've got gold positions that you've been building. I do as well, full disclosure. And I kind of want to go into, I've got all your charts loaded, so feel free to just go ahead and talk and ask me which chart, if you want to do the 10-year real yields, if you want to do the bullion. I want to make sure we get through all this because I think it's very important for people to understand why you're building a gold long position.
Yeah, if you want to pull up that real yield chart, I mean, that's the call for real yields going lower. That's my main thesis for why I think gold will move higher. And those two.
Do you think from a perspective of that, is that the core of it? Yeah, I'm on mute here. Is that the core of the position that you're taking, or is it just a combination of the next few things you're going to talk about? Or, is this a longer term position as well? If you could touch on that a little bit.
look at what the central banks are doing, and this is not just a U.S. phenomenon. It's really central banks around the world that are printing, and they're putting it more in the hands of the average person than what we've seen in the past. In 08, 09, it was pretty much a support financial market activity, where today it's actually getting in the hands of the average individual who has a very high propensity to spend. Now, they've saved a good amount of it initially, but I think a lot of that money is going to roll into the real economy. And this is not a short-term thing. I mean, I really think the Fed is going to have to continue to hold rates down over a longer period, and then that's going to continue to drive prices. As well, gold is not an over-owned position. I mean, when you look at the asset allocation, it's a very small asset allocation. The most funds, most average individuals, don't own much gold. You look at commitment of traders reports in the futures market, it's not an over-owned position. I mean, it's one of those things where all the market has to do is increase its percentage in the asset allocation a small amount, and that's going to be a tremendous increase, I think, in the demand for gold.
All right, so I put up the gold bullion premiums there. If you could talk about that a little bit, because again, I want everyone to understand what's behind this position that you're putting on.
Yeah, so on the supply side of gold, COVID has interrupted a number of mines and also the supply chain for gold, and that's really led to a premium for gold coins, physical gold, over the just the spot market per se. So you've seen literally a physical shortage. You've seen people who, when they try to buy gold, they don't necessarily think of financial products like ETFs and futures. They tend to think of, hey, I want gold coins. And you've had a number of the mints, the Canadian mints, some of the U.S. mints have shut down. And so that has taken a lot of supply of coins out of the market. So what you've seen is premiums in the physical markets of the coins being a premium over spot. You've also seen that a little bit in the futures market. COMEX has had fairly low deliverable gold volumes. Now that has increased as things have started to come back online. That has changed a little bit for futures, and you've seen futures come back down towards spot. But futures had also had a premium over spot for a good amount of time as well.
All right, so if you could, I lost your sound, and that was me losing it. By the way, everybody, I can't wait to get back in the studio as well. This is me trying to stream this show. We've had a much better effect overall in terms of doing the show in our studio, but streaming it, the same technology allows us to do this. Sometimes I lose the handle on. So if you could, Todd, can you, before we go into the next chart, I'm going to put up the personal income chart, because again, I want to make sure we get to all of this stuff. What is the actual position that you're trying to take here? And is it long-term, medium-term? Just give kind of the audience a little bit of a background of what you're trying to do.
Sure. I think medium to long term, I'm looking to own gold and silver. Those are the primary places where I think you're going to see a good amount of the inflation really take hold, and the responsiveness to lower real rates. Gold is more of a currency than what silver is. Silver has a much bigger industrial component. So I think particularly here in the near term, gold is probably going to perform a little bit better. But as people really start to take to precious metals, I think you're going to see silver potentially outperform gold. So silver to me is more of a medium-term play. Gold is a little bit more of a near-term play, just because of the volatility and the less susceptibility to the industrial.
So that's interesting. We were talking to Phil Streible a minute ago, and he said he thinks that silver is likely to be stuck because of the industrial demand. Do you disagree, or is that just kind of a duration issue, a time frame issue?
I think it's a time frame issue. I mean, it is true that silver's demand is over 50% industrial, and I think you saw that in March when you saw silver see a much bigger decline than what you saw in gold. But at the same time, if we continue to see the debasement activities of the Federal Reserve and of the central banks, I think as people start to take precious metals positions, you're going to see that industrial component kind of be less emphasized. And silver, when you look at the relationship of silver to gold, silver is far undervalued historically versus gold. So silver has a lot of catch up to do, and it can move very quickly. So silver is something that I think is probably the better medium to long-term play than gold. And I think it has more upside, but I also think it has more volatility and more sensitivity to downside. So I like owning a little bit of both, but I'd rather own gold here than silver at the moment.
All right, I put up the personal income and broad money supply chart. Can you speak to that a little bit?
Yeah, so I think this is interesting because when you look at the comparison to 2008, the Fed and the central banks have really amplified their activities. So you look at personal income in 2008, personal income went down, and it took quite a while for personal income to get back to the highs again. And you can see here in 2020, you've immediately gone, not only have you snapped back, but you've made higher highs in personal income. And at the same time, money supply. You can see how money supply has ramped as well. Both of those are far higher than what you saw in 2008. So, people, when you think about inflation, they think, oh, we didn't get inflation in really '08 to 10. I think now that the Fed's activities and the fact that you're putting money in the hands of the average individual, not just institutions, the average individual having a much higher propensity to spend those dollars than what a more of a I think both of those bode ill for inflation.
But when you say ill for inflation, you think there's going to be inflation.
Yes. Correct.
That was a yes, right?
Yes.
All right, so let's put up the interest rates monetary base chart. Now, honestly, when I saw this one, this is the one that I didn't really understand what you were trying to get at. So I'm happy to hear you talk about this one. So I've got that up now. If you could just speak to this. And then if you could just kind of wrap up the position and what the whole thing means, because again, I think it wasn't necessarily clear that you are looking for inflation based on that real income, right?
That's correct. I am looking for inflation. So in this chart, I just want people to realize that the policy that the Federal Reserve is undertaking is not a new policy. I mean, the policy of holding rates down while inflation is allowed to move higher, I mean, that occurred in the U.S. in the late 30s and during the 1940s. So this is not a new phenomena that's taking place. This is history kind of repeating itself. And one of the things you can see in this chart is the scale. And that's one of my important themes here is the scale of what the Fed is doing is just much, much larger than it's ever been in the past. And that, I think, is one of the things that's going to lead to inflation as well, because the Fed is really kind of overdoing it. And the one other piece I'll mix in on that front is, we've seen the dollar start to weaken. And a weaker dollar also is one of those inflationary backdrops as well. So all the printing that the Fed is undertaking is starting to impact the U.S. dollar. And that's a troublesome, again, background for higher inflation.
Todd, thanks for being here. Last thing I'll say, I've known you a long, long time. Have you ever been wrong?
Absolutely. I have someone who's never been wrong. They've probably not traded.
Todd, thank you. That was kind of tongue in cheek, obviously, because one thing I failed to say to everybody is that if you're enabled for futures in your E-Trade account, you're trading CME products already, make sure that you don't go too far with these positions and take on risks that you can't accept. Make sure you talk to your rep at E-Trade about how to do this. I think right now we've got a plurality of positions in gold so far. I know Mike Arnold is going to talk about gold as well. When we come right back, I'm going to come back with Carley Garner, who's going to throw us a little curveball here and talk about the S&P. I will be right back.
24/7 access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played.
All right, I'm back with Carley Garner. Let me just adjust the view here so you guys can see Carley because I've got it in a really bad way. So I'm going to fix that. There you are. Carley, how
Great, thank you. It's good to be here.
So just let me tell you, Carley is a senior commodity market strategist and broker. She's a stocks and commodities magazine columnist. She's a street.com contributor. And she also is referenced quite often on Jim Cramer's show. If you ever watch Mad Money, you'll see him talk about the technical analysis from Carley Garner, who he regards, well, you could take his word for it more than you can me, but I've worked with Carley quite a few times, have quite a bit of respect for what she does. So Carley, if you could, can you just kind of give us a little view on your overall market, just sort of the tone of it right now, tech versus everything else, and then I'm going to put your chart up.
Okay, sure. So what we're looking at in the S&P 500 is a market that's gone from whitewash selling to a market that's seeing some dip buyers come in, and that's a big difference from what we saw in March. And so another thing that we're looking at is this market is facing the biggest wall of worry I've probably seen in my career. And you know how walls of worries are. There, if everybody's short and everybody's bearish, it means there's plenty of buying power on the sidelines ready to come in on the dips. And so I think that's the environment we're in. As long as we hold last week's low, I think we're in pretty good shape for the market. If last week's lows fail, we could see like 2750-ish in the S&P, but let's not forget 2750 was a pipe dream in late March. That's higher than most people thought it would get anyway. So I don't think it's such a bad trade-off to build a nice base to make new highs going forward.
Okay, so I want to mention something before we go on that before you talk about this chart, it looks to me like you're looking for a little bit of an expanding range. I'm looking at the chart you put up. It's on the screen right now. You know what your chart looks like. In terms of what you're looking for and how somebody might actively trade that, if that were what they chose to do, obviously we don't want anyone taking excessive risk, but you and I both believe in the futures and the futures options as products. So from a perspective of what you have here on the chart, and talk to us about kind of like what you're expecting and how you would be playing that. And I shouldn't use the word playing. People get mad when I use that, but how would you be responsibly trading that?
Got it. So here's the way we're like the chart that you're looking at is a monthly chart. So this is the big picture. This isn't something that might happen tomorrow or even the end of the week. This is big picture. And what we're looking at, like you mentioned, it's an expanding range. Markets always overshoot. When things are bad, people panic and the market gets worse than reality. It overshoots reality. And I think we usually get that on the upside as well. So that's what we're looking. Everybody's talking about how horrible the fundamentals are and how this market can't possibly go higher. But sometimes fundamentals don't matter. Markets are emotional and they always overshoot equilibrium. So with that in mind, we think that we're in store for somewhere around 3,500-ish in the S&P, let's just say 3,400 to 3,600 by the end of the year. In the next couple of months, if you're looking to avoid the word play, if you're looking to participate in the market, hoping the prices go higher, the best way that I can see to do it, if you're not looking to take a lot of risk, and I wouldn't blame you, this has been a pretty wild ride for most traders. We like the idea of option butterflies. The volatility is so high, the options are overpriced, and so it creates a lot of opportunities to put together limited risk trades that have huge profit potential. So for example, if you were looking to play the September options, they have about 90 days to expiration roughly. You could do something like buy a 3,200 call, sell two 3,300 calls, and then buy the 3,400 call. The market pays off something between 3,200 and 3,400. The most you're going to lose is what you pay for the spread, which is about 700, 750, somewhere in there. And if everything goes perfect and the futures price is around the middle strike price of 3,300, you probably pick up somewhere around $4,200, $4,300 depending on your fill. So it's a good risk reward ratio, way to participate with no downside risk other than what you pay to get in.
Do you have a structural opinion? We talked to Jimmy Iurio at the beginning of the show, and he wanted to do a similar type of trade, but a call condor. Do you have any kind of opinion structurally as to why somebody would want to do the butterflies that you're talking about versus the call condor, or even just like a vanilla call spread?
Sure. So, I mean, they're the same idea. We're basically using the market's money to help finance our position. And so it's the same general idea. I'm not going to say one's better than the other. I guess we won't know that until expiration a few months from now. But the point is options are priced to lose. So you want to make sure that if you are purchasing an option, you're not spending thousands of dollars. For example, in the trade that I gave, if you wanted to just buy the 3,200 outright, I think last time I checked, it was like $5 or $6 grand, maybe even more than that. So, I mean, we're talking a ton of money to buy the option outright, but if you put a spread together, you get in cheap and it's no stress also. anytime you're trading with big risk and big leverage, it's stressful. Sometimes, maybe you can't sleep at night, maybe it's ruining your home life, who knows? Some people take it to that extreme, but with this type of a trade, you can sleep well at night and be comfortable to play out.
How do you feel about the VIX not being able to kind of settle in an up market? And maybe this is more of a fundamental question, but you can certainly respond technically if you want. We haven't seen that all that often. And I've told people that from my perspective, volatility is as much about velocity of moves and sort of the uncertainty of the moves as the direction. A lot of people think higher VIX means a down market. Can you speak to that a little bit?
Sure. So in theory, under most circumstances, you're right. Like the VIX elevates when the market goes down, not when it goes up, because markets usually go down. Well, the stock market, commodities are different, but stocks usually go down faster than they go up. So you do see the VIX trade inversely. That said, in this environment, we're seeing this is not a normal environment. I mean, we've kind of almost grown immune or comfortable to what we're seeing, but it's really super abnormal. If you remember in 2019, we would have thought 100 points in the S&P was a massive move, and now we're getting that intraday. So it's just a different environment, and the options are priced accordingly because heck, anything can happen in a market like this.
It's interesting because one of the things that got me excited as a futures trader was the micros, simply because of that fact, because we do a lot more outright positioning in the futures, and we trade stocks as well, so we could talk about individual stocks. We've got the Apple event today, but this is more of a futures-based episode of Pure Exposure. And so from the perspective of what we do more in the micros, and we just shrink our position size and expand our duration. And by duration in that, I mean sort of price ranges. Do you do that in the options, or are you still kind of sticking with your same strategies and just knowing that the premiums might be slightly different?
An option, it's actually made option trading safer. I don't know if that's the best word. Safe isn't the right word to use when we're talking about trading futures, but the opportunities have been a lot more attractive. Let's put it that way, because although the options are far more expensive, if you're spread trading, you can really get some great trades off for little out-of-pocket expense and risk. And so the option or the volatility has actually really improved option trading. But you're right, as far as the micros go, when they were first they couldn't have been listed at a better time. When they were first listed, some might have said they were boring, but now in today's environment, anything, micros are the perfect way to get a little exposure without putting your head on the.
It's like 1 million a day now, somewhere in that range, the volume on those things. Do you have an opinion of volatility? This is almost tongue in cheek, spiking or compressing around election time?
This is going to be a very interesting year. I really wish I had the foresight to answer that question with certainty. I have no idea. My best guess is, to be honest, I'm kind of surprised the markets is. I mean, I'm bullish and I think we're going to continue to stabilize. But given the polls going the other way and Biden's pretty much expressed his interest in rolling back the tax cuts, I'm kind of surprised the market hasn't looked forward to the election as much as we've seen. I think it's just preoccupied with coronavirus and everything else going on. So it's just a really crazy news year. My best guess is, every time the VIX elevates, we always say this is the new more normal. It's here to stay, and it never does. It always retracts, and I think we're going to get that. The election will definitely be tricky, but I'd say at this point people are focusing on other things, and so we'll worry about that in maybe September is when that'll start coming into play.
You've got a new book coming out. I know your first book was one of the trading bestsellers, and you've got a new book coming out. Can you tell people where they can find that and talk about both books, please?
Sure, absolutely. So the new book is called Trading Commodity Options with Creativity. It's in the editing process. It'll be available in late July. We haven't set an exact date, but it'll be there in late July. And it was quite the project, I'll tell you. We put the amount of work that went into this book probably equates to 2 of my previous books. So it's going to be an interesting one. It was just a difficult topic. It's obviously about option trading, and you know how that goes. It's chasing a rabbit hole into different strategies and things. So we're excited though.
That's great. How many books have you done total?
This is my 5th book, but I've rewritten a couple editions along the way. So if you really wanted to count all that, 8. So staying busy.
That's great. Carley, thank you so much for joining us. I'm gonna let you go because we're short on time, but before I do, just tell everyone where they can get a hold of you if they'd like to talk to you.
Sure. So our website's decarleytrading.com, DECARLEY, trading.com, or you could reach me on Twitter at Carley Garner. So hope to see you there.
Thank you, Carley. When I come back, I'm going to come back with my partner in Path Trading Partners, Mike Arnold, and we will see you guys in just a few minutes. We'll wrap the show up after that.
24/7 access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, 24/7 access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played. I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that.
We are back with Mike Arnold. I am not on the screen yet. Mike is, and I know, Mike, how much you love that. But Mike Arnold is the chief technical strategist, along with being one of the co-founders of Path Trading Partners, 25-year market veteran. He's a strategy and development consultant to multiple hedge funds, former options market maker, traded in New York, Chicago, Switzerland, and like I mentioned, current head of technology and trading systems at Path Trading Partners. Mike, thank you for being here again. I'm going to go ahead and put up your first chart, which one do you want to talk about first, Mike?
Well, why don't we go with crude first?
All right, crude oil chart coming up. Let me put that up and make you small here so everybody can see everything. Give me 1 second.
All right, there we go. August crude oil futures we're watching closely. We actually have a bigger term potential major sell signal and two short-term sell signals all lining up. Now, they require a close below Friday's low. Friday's low in the August crude futures. So that low was 38.51. So on a closing basis, a daily closing basis below 38.51, we triggered two short-term potential sell signals with targets of 36.50. And then right below that at 34.66, you can see it on the chart you have up, we have a major potential double top. So if those sell signals trigger, we hit the first target and then continue lower and get a close below 34.66, we could potentially see a pullback to dual targets of $30.14 and 28.63. Now, if we rally above Friday's high, the two short-term sell signals are invalid. So if we get above 40.69, we're then going to watch for a continued rally, and the double would be at the double top. It's a potential double top, would be invalidated if we trade above 42.20. So those are all the things we're watching on crude from the short side. But again, it has not triggered setups that have not triggered.
So potential setups that have not triggered. When you look at, actually, talk about the hierarchy of questions real quick before I go to your next chart. We can put up the gold chart next. Actually, let's do the Euro chart next and we'll finish it with gold if you don't mind. Talk about your hierarchy of questions because one of the things I like about what you do and one of the main reasons that we partnered up the way we did is that you are very almost uninterested in the fundamentals when you're trading, where you basically just say, look, the price is going to tell me the actions that I need to take. So can you just spend like 30 seconds talking about that real quick?
Sure. A lot of people focus on why. I've done a lot of brain study and research in the way it triggers patterns in the brain. And why is the question that turns out the lowest. You want to focus on what's happening, what's going on, what's the trigger, and then how are we going to take advantage of it. So that's the way we approach things from a systematic standpoint, whether it be crude, whether it be the euro, whether it be gold. What's happening? We have two or actually three potential short signals, and then how are we going to take advantage of it, where we're going to wait for them to trigger, and we're going to map out using just pure technical analysis and price action where the targets are and where we know the trade is wrong. And we don't ask why. We don't focus on, I mean, we'll look at the fundamentals from a cursory point of view, but this is pure systematic, data-driven trading. So we focus on what and then how.
So even if someone doesn't have your mathematical background or your systematic background, they can still focus on what is happening and what they need to do. That's basically what you're saying, right?
Yes, why you can always find a reason to support a bullish or a bearish case. I mean, I hear on TV all the time, if the market's going up, well, why is it going up? And they'll just be an explanation. It doesn't actually have to be why. It just, let's come up with a reason. Or it's selling off, let's come up with a reason. And day to day, that can always shift. Whereas if you just focus on the pure data, you can't get swayed either way. You know what's going on, what's working, what's not, and what are we going to do about it?
I got to pick on the TV guys. I'm going to put up your Euro chart if I could. And Mike always picks on me for being on TV. But I put up the Euro chart now, and I want to get you back in the center of it. But in the meantime, you can start speaking to it, to what you're thinking about. And this is the Euro FX. This is the futures, which they have micros of that as well. People should know. So go ahead and speak to that.
This is a chart of the 6E, the full size contract on the CME. We've had a nice, for anybody who follows Elliott Waves, it was a nice actually ABC pullback straight into the bottom of the daily rotation zone and prior resistance becoming support. So we have a major key level at 111 about 70, and we pulled back just above there on Friday, and now we're rotating back up. We have a potential, again, we're waiting for this to trigger, but a close above Friday's high will trigger a short-term percent B entry signal, which then we'd watch for a return to the most recent highs, 114.28, and then we're looking for 115.13 and 115.98 to the upside. If we get a close below 111, the trade is invalid, and that would be, if it does trigger, that's where our stop level would be, and if it doesn't trigger, that invalidates the whole trade.
So from a perspective of what you're doing here, again, you're not bullish or bearish. It's whatever triggers, that's the way you're going to go, correct?
Correct, and I am fundamentally, I mean, I'm bearish on the dollar. It just so happens that the euro is the best play right now to take advantage of a bearish dollar. But even if I wasn't bearish on the dollar, it would still be, this is the play, this is the setup, this is what we're waiting for trigger.
Yeah, we've had conversations about correlations in the past, and it's something we're trying to do in the Pure Exposure Growth series is give you guys actionable examples of what you could be doing, obviously within risk parameters and with the parameters that fit your personal financial situation. We are not financial planners. We're not advisors. We're not registered representatives. So make sure that you talk to your E-Trade representative if you're enabled for futures, and if not, you should be. You speak to your registered representative as to what's appropriate for what your plans are. Mike, I'm going to put up your gold chart now. We've had a lot of opinions on gold today, three of them actually, and they've all been bullish. So your gold chart is now up behind you. Tell me what you think of gold, please.
Gold, well, full disclosure, we're already long gold from an earlier rotation play, and now we're looking for another add-on play in gold. When you have the chart up, it's weekly gold. I put up a weekly chart because this shows, again, really nice concepts here of pulling back. We made highs back in April and then retested those highs in May, drifting sideways, letting a concept we have between the orange and the blue lines are a rotation zone. We pulled back. We also pulled back to a key significant level of 1680. And now we've rotated back up. So right now it's actually looking to trigger. We're at 1776 right now on the daily. As long as we close above about 1775, that will trigger a daily entry. We mentioned earlier, somebody mentioned on 1789, which is a key level we're watching. That's the first little area of resistance, but as long as we get a close above 1775, that triggers it. Then we're looking to 1830 and 1872 are the next target levels up. We're going to most likely trail this out. Those are the targets we've come up with for proper risk to reward, but gold I'm looking to continue to run higher, so this will be something we're just going to continue to trail. If we get a close below 1679, if we're in the trade, it stops us out. If we're not in the trade, it would invalidate it.
You ever get nervous when you look at something like gold? Obviously, we've got a lot of volatility in the equity markets, and they could potentially sell off, and that could potentially be beneficial for gold, unless it's like the sell-off that we saw in March where every asset gets sold. You don't consider it at all, right? It's just basically where the price action reverses. You've mentioned price levels on both sides of the current price action. It doesn't bother you, right? I mean, that's the trade, and that's what you're doing.
That's the trade, and you map it out and you position size accordingly, and you know your risk, you know your reward, you should know your risk to reward ratio. And once you've mapped it out, it's then just executing the trade. There is no emotion. If you're going to be over emotional, you shouldn't be in the trade to begin with, and you should know that based off your risk and reward parameters. Either you're trading too big or you're not following your rules. So if you're not going to do that, don't be in the trade.
Yeah, I always tell people that the only time you're thinking clearly about a trade is prior to being in it. So that means, translation of that, plan every aspect of the trade. And it's really not as complicated as that might sound. Plan every aspect of the trade just means plan your entries on both sides of it prior and try and stick to it. Mike, where can people get a hold of you if they need to? And then I want to have some closing remarks. But if somebody would like to talk to you, where can they reach you?
They can go to the website, pathtradingpartners.com. They can email support@pathtradingpartners.com, and I will get it either way. There's a contact us button through the website.
Michael, thank you again for being here, for showing everybody that stuff. That
24/7 access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played.
That matter to you guys. So from a perspective of what we're doing here, cheers everyone. I'm Bob Iurio from the Pure Exposure Growth Series, and you have just been exposed. Take care, everybody.